Listen, let's be brutally honest about the situation. On January 27th, 2025, a Chinese AI company that was virtually unknown to the general public, DeepSeek, didn't just ruffle some feathers, they detonated a bomb in the financial markets. In a single trading session, they managed to erase $589 billion from Nvidia's market capitalization. That is not a typo. That is nearly the entire GDP of Belgium or Sweden, vanished into thin air in 6.5 hours. The Nasdaq took a 3% hit. The tech sector turned into an absolute bloodbath, with Broadcom shedding 11% and even untouchable giants like Alphabet and Microsoft bleeding value. But here's the specific detail that keeps me awake at night. This wasn't a market crash caused by a system failure or a bad earnings report. This was a valuation crisis. It was a stark wake-up call signaling that while America thought it was winning the game by throwing infinite capital at the problem, China has been playing by different rules, and they might actually be pulling ahead. Let's look at the numbers that terrified Wall Street. DeepSeek released their R1 model, which performs on par with OpenAI's OL1 and GPT-4o, models that cost huge US firms hundreds of millions, if not billions, to develop and train. DeepSeek's claimed cost? Around 5.6 million. They didn't use massive clusters of 10,000 band H100 chips. They reportedly used a cluster of just 2,000 older, less powerful H800s. They achieved with efficiency what Silicon Valley insisted could only be achieved with scale. And that is why the market panicked. The entire US AI thesis, the scaling laws, is built on the assumption that you need to spend $100 billion on data centers and ultra-expensive chips to stay competitive. DeepSeek proved that assumption wrong. If you can build state-of-the-art AI for $6 million instead of $600 million, then Nvidia's profit margins are essentially a mirage. The moat wasn't real. I have been tracking the economic relationship between the US and China for months, and honestly, the findings are terrifying. We are seeing a Sputnik moment for the digital age. Before we dive deep, make sure to hit that subscribe button because this story is moving rapidly and you need to keep up. Let me rewind a little to give you the full context of what is actually unfolding here. For years, the dynamic between China and America has been that of economic frenemies. We purchase their goods, they purchase our debt, and everyone profits. But 2024 was the year things started to get strange. Officially, China's economy hit 5% GDP growth last year. On paper, that sounds fine. In reality, it's misleading. When you really drill down into the metrics, the picture is grim. According to the World Bank's December update, property investment in China plummeted by 10.6%, the steepest drop since records began in 1987. New construction starts were down 23%. Property sales fell by 12.9%. Just think about the scale of that. The property sector, which essentially serves as the backbone of Chinese household wealth, is crumbling. So how did Beijing respond? In September 2024, they finally deployed what analysts described as the fiscal policy bazooka. For the first time since 2011, they pivoted to a moderately loose monetary policy. In plain English, that means they panicked and started throwing cash at the problem. They announced 10 trillion yuan, roughly $1.4 trillion, in local government debt refinancing, along with new liquidity facilities for the stock market. And surprisingly, Chinese stocks did surge. The MSCI China Index returned 15.61% between July and December 2024, based on Bloomberg data. After 3 consecutive years of losses from 2021 through 2023, investors finally saw green. But here's the detail nobody discusses. Less than 10% of Chinese households actually own stocks. Compare that to over 60% in the US. So, while the markets are rallying, average Chinese citizens are still broke and anxious. Now, we have to address the elephant in the room, Trump. During the 2024 campaign, Trump floated the concept of slapping 60% tariffs on all Chinese goods. 60%. That isn't a negotiation strategy. That is total economic warfare. Throughout late 2024, multiple outlets reported on this threat, and economists at BBVA Research estimated this could drag down China's growth by about 1% if enacted. That might not sound like much until you remember China is only growing at 5% to start with. But this is where it gets complicated, and the data actually shocked me. American companies are the ones terrified. Let me name names. Apple derives 16% of its revenue from China. But the crazy part is that Apple doesn't manufacture in the US. They build everything in China and sell it globally. If Trump hits Chinese goods with tariffs, the penalty hits American consumers, not Chinese ones. Your iPhone just became significantly more expensive. Tesla gets 21% of its revenue from China. And get this, Tesla's sales in China dropped 19% year over year in early 2024, according to the China Passenger Car Association. Meanwhile, the Chinese EV giant BYD is devouring their market share. BYD reported a 29% jump in pure EV deliveries, while Tesla's market share in China shrank from 7.7% to just 4% between March and April 2024. Nike manufactures the bulk of its products in China and Vietnam. Intel gets 29% of its revenue from Chinese clients, but manufactures in the US. The tariff war impacts everyone differently, but it impacts everyone. Analysts from various firms, including the Motley Fool, noted that major US companies with high China exposure, Apple, Tesla, Nike, Lululemon, Starbucks, all significantly underperformed the broader market throughout 2024, even as the S&P 500 was up over 20%. Want the truly wild statistic? After Nike reported earnings in March 2024, their stock fell over 8%. Lululemon dropped over 19%. This wasn't because their business models were broken, it was because investors were pricing in the China risk. This brings us back to the catalyst I mentioned at the start. On January 23, 2025, DeepSeek, founded by hedge fund manager Liang Wenfeng, released the R1 model. By January 27th, their app skyrocketed to the #1 spot on the Apple App Store, shoving ChatGPT down to second place. That is when the broader market imploded. Microsoft dipped 2%, Alphabet fell 4%, and the entire AI infrastructure narrative was called into question. Mark Andreessen, one of Silicon Valley's biggest investors, called it one of the most amazing and impressive breakthroughs he has ever seen. He literally compared it to the Soviet Union's Sputnik launch. That is the magnitude of this event. Here is what really freaked everyone out. The US has spent years restricting China's access to top-tier AI chips, citing national security. We cut off their supply, yet they built this anyway. Think about the implications. Either DeepSeek is lying about the costs, and so far nobody has proven that, or China just demonstrated that you don't need to spend billions on AI infrastructure to compete. You just need to be smarter. Some analysts, like Bernstein's Stacy Rasgon, believe the panic is overblown, telling Yahoo Finance this doesn't spell doomsday for AI infrastructure. Others, like Futurum's Daniel Newman, argue this is positive because efficient AI means higher adoption. But here's my take. Wall Street isn't panicking because DeepSeek is good. Wall Street is panicking because America's lead in AI just got much smaller, much faster than anyone predicted. So, what happens next? I see 3 potential scenarios unfolding. Scenario 1, the trade war escalates. Trump takes office and actually enforces those 60% tariffs. China retaliates. American companies with heavy China exposure, your Apples, Teslas, and Nikes, get crushed. Supply chains that took decades to construct get torn apart in months. According to CraneShares' 2025 outlook, some analysts believe Trump might seek a grand bargain with China after using tariffs as leverage, but that is optimistic. If this goes south, we are looking at years of economic pain. Scenario 2, the AI race goes into hyperspeed. DeepSeek proves this wasn't a fluke. Open source AI becomes the standard. Suddenly, the billions US companies are pouring into proprietary models look like massive waste. The entire AI value chain gets disrupted. But here's the flip side. If AI becomes cheaper and more efficient, adoption explodes, productivity surges, the total addressable market grows. According to IoT analytics, end users and AI application providers could be the big winners. Chinese tech stocks have already started bouncing back. The MSCI China Index was up 13.9% year-to-date as of mid-February 2025, dramatically outperforming the MSCI USA Index's 4.4%. Analysts at AllianceBernstein think DeepSeek created a halo effect that is making investors take a fresh look at Chinese tech. Scenario 3, decoupling accelerates. This is the one that worries me the most. The US and China just split. Not entirely, but enough to matter. Companies frantically diversify supply chains. Critical technologies get siloed. The world fragments into competing tech spheres. Apple is already trying to hedge. Recent reports show they have intensified efforts to move manufacturing to India and Southeast Asia. But here's the problem. Every move they make to reduce exposure pisses off Beijing, and Beijing can turn off iPhone sales in China like flipping a switch. According to Rest of World, Apple's China revenue already dropped over 10% in 2023, falling from just under $24 billion to just under $21 billion. That is a $3 billion haircut, and that was before tensions really spiked. Look, here's what you need to understand. The narrative that America is untouchable in tech just died. China isn't just catching up. In some areas, they might be leapfrogging us. The companies you own stock in, the products you buy, the entire global economy, it is all getting reshuffled right now, and it is happening fast. I'm not saying you should panic. I'm saying you need to pay attention, because the decisions made in Beijing and Washington over the next few months will determine whether your portfolio goes up or down. whether your iPhone costs $1,000 or $2,000, and whether we are looking at a decade of prosperity or a decade of economic Cold War. So here's what I want you to do. First, smash that subscribe button because I am tracking this story every single week. Second, drop a comment and tell me, do you think American companies should pull out of China, or is that economic suicide? I'm genuinely curious about your thoughts. And third, I have a video coming out next week about which specific stocks and sectors could actually benefit from this chaos. You're not going to want to miss that one. The US-China relationship just entered a new phase. The question isn't if things are changing, it's whether you are ready for it. Thanks for watching, and I'll see you in the next one.